we are not yet seeing full signs that the economy is slowing down in the way the Fed would like. Specifically, the Federal Reserve is still concerned about the fact that the labor market remains very strong. Hi guys, it's Stock Curry, and it's time to get ready for the Fed meeting on Tuesday and Wednesday. In today's video, we'll discuss everything the Fed is looking at in making their determinations and how their decisions will affect the market over the next few months. So let's get into it. On Monday, U.S. stocks fell going into the Fed meeting. We talked about this in yesterday's video, how the run-up of the past 3 weeks may have topped out and we might see a little bit of a pullback going into this week. However, this is just leading up to the Fed meeting. I do believe the stock market wants to sell off on Monday and Tuesday, and then on Wednesday, it will just come down to whatever the Fed does. We had way too fast of a run-up over the past 3 weeks, and the market needed a little bit of a breather before it attempted to continue the rally. Now, after this, it's all going to come down to what the Fed does on Wednesday. At this point, it's pretty much locked in that the Fed is going to do a 25 basis point rate hike. Now, there are some people saying the Fed should not raise rates. There are other people saying the Fed should raise rates by 0.5%. But the reality is the Federal Reserve always does an excellent job of forecasting how much they're going to raise rates by, and they have forecasted pretty strongly that they're going to raise rates by 0.25%. Now, when that decision is made on Wednesday, I do expect an initial rally on the stock market. However, after that, Jerome Powell is going to speak, and where the market goes from there is really going to determine based upon what Jerome Powell says. But more importantly, not so much why they raised rates by 0.25%. What the market is really going to be listening for is how long the Federal Reserve is going to keep these rates elevated and when they might start cutting back and lowering rates once again. Right now, the stock market is pricing in the Federal Reserve doing a 0.25% rate hike at this meeting, and then no more rate hikes for the rest of the year, and then lowering rates in the second half of 2023. If Jerome Powell comes out and says anything that sounds more hawkish than that, that could send the markets down. Right now, it's a big unknown. There's absolutely no possible way to predict it. However, I am going to go through today and show you a lot of the data that the Federal Reserve will be looking at in trying to determine how long to keep these interest rates elevated and whether or not to lower rates towards the second half of this year. The Federal Reserve's interest rate strategy for the rest of 2023 hinges on how quickly rate increases slow the economy. Rate increases typically take about 6 months to work their way through the economy. And while we are seeing some signs of the earlier rate hikes affecting the economy, such as the fact that inflation has now dropped for the 4th month in a row, we are not yet seeing full signs that the economy is slowing down in the way the Fed would like. Specifically, the Federal Reserve is still concerned about the fact that the labor market remains very strong. However, as I mentioned in yesterday's video, the labor market is showing quite a few signs of falling apart and slowing down. And in just a minute, I'm going to give you some details on that. But first, I want to show you a few other areas where the economy is showing some signs of weakness. Apple is reporting earnings Thursday after the close, and they are expected to have their first revenue decline since 2019. Now, it's important to understand that even if Apple beats earnings expectations, a revenue decline is really bad news for the company. and the stock price might rise a little bit on Apple beating expectations, meaning revenue did not decline as much as analysts think it will. However, we must understand that what really matters is the forward guidance. So if Apple reports a revenue decline in this quarter and then they guide for another revenue decline next quarter, we could see the stock fall fairly significantly. And what's been happening lately is in last year, 2022, we saw multiples. Those are those very high PE ratios start to come down as the stock market sold off. But over the past 2 quarters, we've seen earnings decline significantly, but stock prices stopped going down. And in many cases, stock prices have actually risen. And what that means is that the multiples, those PE ratios, are now elevated once again. And we need another downturn in the market to get the PE ratios or multiples back down to a more reasonable level. So this earnings season, especially the earnings that come out on Thursday, are going to have a significant impact on the stock market over the next 3 months until next earnings season. In addition, Phillips has announced another cut of another 6,000 jobs. As more and more companies do layoffs, this is going to slow down the labor market. But so far, we've seen in the official jobs numbers how the total number of jobs has increased by 233,000. In yesterday's video, I went through in great detail and explained why that 233,000 number is not super accurate. And if you dig a little bit deeper, you find some serious cracks in the labor market. If you missed yesterday's video, make sure you go watch it. I'll post a link to it at the end of this video. First, let's take a look at some more details on where the economy currently stands and some of the data that the Federal Reserve will be looking at in trying to determine if a recession is on the way or not, and whether or not they need to keep interest rates raised or if they can start lowering rates towards the end of this year. An article came out in the Wall Street Journal today titled "The U.S. Consumer is Starting to Freak Out." This article does a really good job of explaining what's going on in the economy, so let's go through it. The backbone of the U.S. economy, that is consumer spending, is starting to slow down. Retail purchases have fallen in 3 of the past 4 months. Spending was flat in December after adjusting for inflation, which was the worst monthly reading in nearly a year. Sales of existing homes in the U.S. fell last year to their lowest level since 2014. That's the lowest level in 8 years. And the auto industry posted its worst sales year in more than 10 years. The share of monthly income Americans set aside for savings was 3.4% in December, down from 7.5% a year earlier. And on top of that, credit card interest rates have been rising. The share of U.S. adults whose monthly expenses were more than their income has been rising as well, especially amongst those who make less than $50,000. But in reality, it's been rising across the board regardless of income. And don't forget, consumer spending accounts for roughly 70% of the U.S. economy. The fact that consumer spending is slowing down has led 61% of economists to think that we are going to get a recession sometime this year. There are also signs that the labor market is slowing down. Employers are shredding temporary workers at a fast rate, and people who lose their jobs are taking longer to find new ones. Meanwhile, the number of hours worked a week has declined for 2 straight months in a row, and this has caused a slowdown in workers' take-home pay. The increases in inflation and credit card rates have gradually started to slow down consumer spending, but it might take a while before the full effect is realized. Credit card balances were up 15% on the year in the third quarter, which is the largest increase in more than 2 decades. This increase is because Americans can no longer afford to pay their bills, and so they're putting more and more purchases on credit cards. To make matters worse, tens of millions of Americans are set to start resuming making payments on their student loans later this year. And this tax season won't be much help either, because many taxpayers will get smaller refunds when they file their returns in the coming months, because Congress did not extend the breaks that were put in place at the height of the pandemic. During the pandemic, unemployed Americans could receive payments for as long as 18 months, and in some cases, workers were paid more than their paycheck. Now, most Americans who lose their jobs can expect unemployment payments for only 6 months or less, and at a fraction of their former paychecks. All of this is causing U.S. factories, shippers, and importers to pull back in a sign that they anticipate less demand from Americans in the months ahead. Inbound volumes at the ports of Los Angeles and California were down 20% in December from a year earlier. So as you can see, and as I explained in yesterday's video, all of the forward-looking data is pointing to a significant slowdown in the U.S. economy, as well as a possible recession in the second half of this year, even though the backward-looking data still shows that the economy is quite strong. The question is, how fast is the Federal Reserve going to react to a slowdown in the economy? If the Federal Reserve reacts quickly and starts cutting interest rates at the end of this year as the economy starts to slow down, they might just pull off a soft landing where we get inflation back down to 2% and also avoid a major recession. However, most people think the Federal Reserve will be slow to react as they focus more on backward-looking data instead of the forward-looking data, and they think the Federal Reserve is going to cut interest rates way too slow and much later than they should, possibly not even cutting rates until 2024. And a lot of people think this is going to cause the U.S. economy to fall into a recession in the second half of this year. Now, there's a question yesterday in the video. Somebody put in the comments that they wanted to know how the quantitative tightening, that is the Federal Reserve's buyback of mortgage bonds as well as the Treasury bonds, was going to affect the economy. And you have to understand that the quantitative tightening that's taking place, first of all, it is just a small, minuscule fraction of the Fed's total balance sheet. So it has very little impact on the overall economy, but the very little impact it does have helps to raise interest rates a little bit higher, specifically on mortgages and Treasury bills, but not much else. This could cause housing prices to become a little bit more unaffordable for a little bit longer, but outside of that, not a huge difference. Now, if you want to know how we're trading this and all of the decisions that we are going to be making to try to make money as this Federal Reserve decision comes out on Wednesday and as the major earnings from these companies come out Thursday after the close, then come join our coaching program where I'm going to show you not only what we're doing and what we're watching, we're also going to show you how to trade options so that you can make money no matter if the market goes up, down, or even trade sideways. And I wanted to let you know that the prices for the coaching program are increasing on February 1st. So if you want to get in, make sure you sign up before the end of this month. This is your very last chance to get in at the discounted prices. We are raising the rates on February 1st. If you want more information on that, schedule a call with an onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family. And don't forget to hit the like button and subscribe. And if you missed yesterday's video with all of the detailed information on the jobs market and all of the economic news and earnings that are coming out this week, make sure you go watch the last video that I posted here.